Welcome to this explainer. If you've been keeping an eye on the financial landscape lately, you might be feeling a real mix of curiosity and, honestly, a pretty healthy dose of caution. And as a financial advisor, let me tell you, that is exactly where you should be. Today, we're taking a structured, level-headed look at an asset class that is literally reshaping global economics. We're going to examine the realities, the mechanics, and most importantly, the boundaries of safety in this new digital financial world.
Just think about that for a second. What if I told you that the actual money sitting in your bank account right now is fundamentally changing? For centuries, we've relied on centralized authorities to control our finance, right? Kings, governments, massive banking institutions. But there's this quiet revolution happening right under our feet. And it's powered not by paper or sovereign decrees, but by pure math and code.
Okay, let's really dive into this. We're going to completely strip away the extreme hype, the confusing technical jargon, and those sensational horror stories you constantly see popping up on your social media feeds. Our goal here is objective reality. By the end of our time together, you're going to understand exactly what cryptocurrency is, how the underlying tech actually works, and the realistic risks and rewards you absolutely need to know as a cautious observer or investor.
So here's our roadmap. We'll start with the financial paradigm shift. Then look at replacing the bank middleman. After that, we'll unpack digital scarcity and smart contracts, navigate the reality of extreme market volatility, and finally, lay out the absolute rules for cautious investors.
Let's kick things off with Part 1, a financial paradigm shift.
Which leads us right into Part 2, replacing the bank middleman.
To really understand this new era, let's look at traditional money. When you send $100 to a friend, you aren't actually handing over physical cash, right? The bank acts as this trusted middleman. They're basically just updating a private notebook, their ledger. They subtract 100 from you and add 100 to your friend. Well, cryptocurrency cuts out that central bank manager entirely. So instead of one private centralized ledger, a crypto network uses a decentralized public ledger, meaning that exact same record is shared simultaneously across thousands of computers all over the world.
Now, when my clients ask me, well, who oversees this new system? The answer is no one. It isn't verified by some human being sitting at a desk. It's actually verified by the network itself using incredibly advanced mathematics and cryptography, which, by the way, is exactly where the name cryptocurrency comes from. Once your transaction is approved by the math, it gets grouped into a data block and then firmly chained to all the previous blocks. And boom, that creates the blockchain. It's an unchangeable, permanent record. Essentially, advanced math replaces the traditional bank's authority.
Moving on to Part 3, digital scarcity and smart contracts.
So, you might be wondering what actually gives digital code its value. Well, think about a familiar legacy asset, like gold. Gold is historically valuable because it's scarce, it's incredibly durable, and frankly, it's pretty difficult to mine out of the ground. Cryptocurrency was designed to mimic those exact properties, just digitally. Traditional fiat currencies like the US dollar or the euro, well, they can be printed infinitely by central banks. And as we all know, that infinite printing ultimately decreases your daily purchasing power through inflation.
So the absolutely crucial point here is mathematical scarcity. Take Bitcoin, for example. It has a hard-capped maximum supply of exactly 21 million coins. That's it. No more can ever be created by anyone, ever, period. In my advisory experience, this mathematical hard cap is exactly why so many cautious investors view it as digital gold, a reliable hedge against fiat inflation.
But it actually builds into something even larger than that. Crypto isn't just about a digital version of gold anymore. Platforms like Ethereum introduced what we call smart contracts. These are entirely automated, self-executing financial agreements. The terms of the deal are written directly into the code itself. There's no broker, no lawyer, no middleman required at all. This allows developers to build entire financial systems, apps, and digital marketplaces that run 24 hours a day, 7 days a week, completely without human intervention. It's a real game changer.
Which brings us to a very important reality check in Part 4, navigating extreme market volatility.
Look at the sheer scale of the difference on this daily market volatility comparison. Let's be completely honest with each other here. This is not a get-rich-quick scheme. In traditional stock markets, a 2 or 3% move in a single day is a huge deal. But in the cryptocurrency world, It is completely normal to see assets wildly fluctuate by 10, 20, or even 30% in a matter of hours. This market is heavily driven by human emotion, wild speculation, and rapidly shifting global regulations. Surviving this requires ironclad emotional discipline. Without it, you really risk losing your investment to these sudden price swings. And that leads us to our final section, Part 5, Rules for Cautious Investors.
Listen, if you ever decide to step into the digital economy, you absolutely must follow these rules. First, do your own research, often abbreviated as DYOR. Never, ever buy an asset just because some social media influencer told you to. Second, prioritize your own security. Remember, there's no 1-800 customer service number to call if you forget your crypto password. You really need to use hardware wallets, these are physical devices, to keep your private keys safe from hackers. And third, never invest money that you rely on to pay your rent, your mortgage, or to buy your groceries. Surviving those immense 30% daily swings we just talked about requires strict emotional discipline, and you simply cannot maintain that if your actual livelihood is on the line.
At the end of the day, cryptocurrency is proving to be much more than just a new way to pay for a cup of coffee. It represents a fundamental shift in how we define ownership and trust in the digital age. Whether it eventually becomes the dominant global currency, or if it simply coexists peacefully alongside our current traditional banking systems, the underlying blockchain technology is clearly here to stay. As an advisor, my best guidance is this. You have the power to just watch, learn, and engage safely as this tech continues to reshape our global economy.
So, I'm going to leave you with this question to thoughtfully evaluate from your own financial perspective. As the math and the code continue to evolve, do you believe cryptocurrency is truly the future of finance, or is it merely a digital trend that'll eventually fade away? Keep learning, keep doing your research, and definitely stay curious. Thank you so much for joining me for this explainer.